Good afternoon from one retail investor to another. This is Trader72. Welcome back to my YouTube channel on this fine sunny afternoon in London. It is absolutely beautiful. Blue skies, not a cloud in sight. And I'm inside. But that shows you dedication to the end to becoming a retail investor. That is what it takes. Sometimes, but it is what it is. I had a great weekend, so I can't complain. So yeah, great, fantastic. How are you all doing today? So today's upload is effectively about SaaS. What is SaaS? What is going on with SaaS? And what is going with the SaaS storm? Or SaaS apocalypse, I should say. It's a quite mouthful, but it has been a stormy sector for the past 2 or 3 months, especially since the start of the turn of the year. The darlings of AI software of the market, well, certainly not darlings at the moment. They're all down by quite a bit, which we'll see in a minute. So that will be the discussion of a selection of SaaS companies that I've chosen that may well survive or not survive the AI revolution. I don't think that none of them will go bust overnight. Let's not go crazy like some people do in terms of for a headline. We're all about headlines and thumbnails, but this is more about really where I feel the business is going to be within the next 5-10 years, and will it still be around or swallowed up, or whoever survives. So I've selected, some of you may feel that I've missed out on a few, but these were the ones I felt the best, that I researched the most on at this point in time. Now, before we go further, we'll do obviously a complete little slide in terms of graphics, in terms of which company are where, which one I feel will be the winners and will be the losers. Also going through obviously the main headline of yesterday, the ceasefire for 2 weeks between Iran and US. The markets are clearly buoyant at the moment. So we'll come to that and have a quick look through that in terms of where the markets are at the moment. My portfolio as well, which obviously some of you may know, I took out half of it out yesterday in thinking that it would be an uptake on the war, which didn't happen. I should have probably known better, but I was being protective of my account, which sometimes some of you, we should all do that at best. I took out SPGI and Uber, and to my mistake, that was a mistake, because obviously they all went up this morning, although they are slightly coming back down now off their highs. We'll come to that in a minute anyway. So without further ado, let's go for the analysis of SaaS and what will survive or not. Firstly, what is SaaS? SaaS is obviously software as a service. That's what it stands for. I must admit, I've heard it quite a few times, but it's nice to always see it on screen for some of you that may not know. So obviously that includes Salesforce, Adobe, Workday, etc. It's a predictable, scalable market. It's been one of the most profitable businesses models in the last decade at least. And today we're going to go through why the model is under pressure. So let's go to firstly, what are the initial problems that we're seeing? What are the experts even saying are the issues we're seeing with software?
Fear of software in the AI disruption, SaaS apocalypse, whatever you want to call it. When you look at some of the carnage, specifically in public markets, how much of it is just an issue of sentiment, a narrative that's gotten wrong, something wrong, or an actual fundamental issue with software?
Yeah, well, thank you. It's a great time to talk, because we see so much opportunity in this new world of AI. We don't necessarily view SaaS and AI as different things. All of our software companies are using AI, they're selling AI, they're developing AI, and so we think the public markets, particularly for companies that have a certain set of attributes, and I can describe those attributes, but are not being very discerning. In other words, to think that all software is the same, we think is, they're missing the mark a bit. And so we love the way values are trending, especially in our space. And when we compare that to the performance of our companies, which is very strong, we think this could be a really exceptional buying opportunity.
Well, he would say that, of course, because I'm presuming that obviously he owns quite a few of those companies. But he is right in terms of the value of those companies and where the value is at the moment. Obviously overvalued for many, many years, and now suddenly at a discount. So that will be interesting to check as well.
the idea of software companies' value lying in being a scapegoat, essentially, for when things go wrong is kind of funny and dystopian, I think, in many ways.
Yeah, I mean, I think, it's a real fear, right? And the way I think about it is there are two arguments against software right now. One is the world is going to stay the same, but software is just going to get a lot cheaper over time now that it's cheaper to build. And I think there's no one who would argue that it's not gotten dramatically cheaper to build. For reasons that we laid out in our deck, and we can talk through it more, we don't buy that argument. I don't buy that argument. But the second is the world's about to get really weird. And the way that knowledge work happens is going to change. And if we think out 3, 4, 5 years, who knows if there will even be customer support reps or sales reps or software engineers. And I think that's what's causing the kind of hit to the share prices.
So that's where we are with some of the experts, obviously, who believe that obviously SaaS will not be replaced and will be around, and it obviously is a melting pot of different ideas of what will happen in the future. Obviously, if we could all see the future, we'll all be millionaires. So let's get to my analysis now of the players that we're talking about here. So let's start with this first slide here. Obviously, Salesforce is down 25% currently. Obviously, it's a sales marketing tool, which is used by many, many different big companies. It's been around for quite a while. Adobe, obviously, creative, obviously lots of different apps, graphics. Obviously, I come from that industry for many, many years, and Adobe was a main player. Obviously, has a huge moat at the moment, even so some people may argue with that. But 26% down off its highs at the moment. And Workday, which obviously is more HR and accountant, is down almost 35% since February, which is a significant amount of its high. So it's HR and finance and so forth. So all of these companies rely obviously heavily on software. They've got different outlooks we'll come to in a minute. Now, moving on to the other players, Intuit, obviously, which is regulatory moat, it's tax laws, it obviously deals with taxes, personally and for companies. Accountants across the world use it. QuickBook, obviously, is one of the main ones. And currently, at the moment, in very much the main runner of that market. Shopify, we know about Shopify, obviously, e-commerce infrastructure. Controls about 14% of US e-commerce, which is obviously quite a large chunk, and is currently at the moment as well off its highs of 25% year on year from 26 due to valuation and reset fears. Possibly less of the 6 in terms of the actual SaaS situation, but it is still coming off its highs from that point of view. Palo Alto, obviously, which is cyber security, also off its highs at the moment. Not as much as the others, but again, very much part of the SaaS network situation. Competition is intense. Security vendors, you bundling platforms, which could also be replaced eventually. So that is the other players there. And then, least but not last, S&P Global and Moody's, which we know are ratings agency, huge moat in America, one of the biggest ratings agency in the world. S&P Global, which some of you may well know, I've done an analysis, and I own the stock up to yesterday. Which I wish I'd kept it now probably, but beauty of hindsight. I'll explain that again later on. We'll come to that. Fantastic company, owns the S&P Global Index, S&P Index, sorry, not Global, and also owns the credit agency and the insurance, which obviously credits the companies for cash in terms of bonds. So a very important part of the monetary system in the US. Moody's very similar, and they have a duopoly there, which is what you call it, a duopoly of this market. So again, very much for some reason fell into this SaaS software, and this is where my arguments will be in terms of especially these two, of where they're at the moment, in terms of the fact that they got caught out into this apocalypse. Down 10-15%, I think more than that at the moment, although it's at 439 at the moment, and obviously 16% off for Moody's as well, which got caught into that storm, literally caught into that storm. So who are the winners of this? Who do I think is going to come at the top end of the list in terms of going through that storm, going through that situation where the markets do tend to get into a panic about this certain companies with the AI revolution and who will come out on top. In my opinion, obviously, I'm not a financial background. This is purely my finance. You please do your own due diligence on this. And if you disagree with me, please do comment below. So who are the strong survivors? Well, S&P Global and Moody's. I am not saying that just because I've like S&P Global and I've picked S&P Global in my portfolio many of times. I think it's both terrific companies who have a huge moat on network effects and are part of the fabric, really, of the financial system in the US. So as it stands now, it's not a software company, it's an infrastructure. So let's get this clear. That is where I disagree with this storm at the moment. Of all of them, really, it's probably the one I agree the less with in terms of where it's at and why it's been stuck into that trend, because it is actually financing further AI, and of course will increase its AI capabilities as it goes on. So it will not be beaten by it, but we'll join it, I feel. So that's where I am at. It's a tool booth. Obviously, it's not a tool. It's a basic, like I said, infrastructure. It needs to be run by, in certain sections, by humans, not by AI. I think it will be eventually, potentially might be, but that obviously I may well be wrong. But at this moment and in the future, the near future, I feel that S&P Global will be, there's too much at risk in terms of leaving it to an AI agent to give a company credit rating of any kind, especially when there's that much money involved. So I think it's certainly something that we have to look at in that respect. It does need AI. Obviously, it has AI in its data. But I think in terms of rates, bonds, and the S&P itself indexed, it does need to be controlled by humans, not by AI. And I've stated the obvious here. I think that's why it shouldn't be part of this storm and this downfall. So I think that same goes for Moody. I think Moody has a very similar business, except not as wide as SPGI. But it's, again, transforming SaaS. It's transforming itself within in terms of AI. So I think these two are certainly, for obvious reasons, strong survivors of, and high conviction, as it states there, winners, if there is such a thing as a winner. So I think that will be where I feel these two sit. Now, going more towards the middle ground now, and what we would call the conditional winners, Adobe and Shopify, I think, are in that middle ground. I think that Adobe, who obviously own on my stock, which I bought a little bit too early, has clearly been very much punished. It's 26% down alone this year. Questions obviously of its moat and the fact that other companies are eating into that moat, such as Canva and so forth. And for sure, it's struggling a little bit more for that. But the numbers and the fundamentals are certainly not showing that at the moment. It's a strong stock being punished because people think that it will be taken over by AI eventually. Some of their applications will be AI alone. But if we look deeper into Adobe, it has Firefly, which is heavily invested in, and that Firefly is obviously all AI condition. So I think in terms of enterprise AI, it has a huge advantage already, as it says there, to have that tool already on most of their editing software. So from that point of view, I think that's it's perfect vindication of why I think Adobe will potentially survive. It still needs high-end tools. There's still a huge creative services behind it that needs Adobe. It will not disappear overnight. And I'm stating pretty strongly that at this moment, yes, there may well be, as I said, AI may well come into play at some stage and eat into the moat that it obviously had, but I still think that it will be a premium business going the next 5-10 years. And this is what you've got to ask yourself: where will this company be in 5, 10, 15 years down the line? Especially from a value investing point of view. Some value investors obviously own companies that long, and I think this is a big question you ask yourself. My opinion, Adobe will be around for a lot longer. Shopify, because it's e-commerce, again, very much in a massive mode. I can't see that disappearing. Especially a winner in a strong economy, which it kind of still is at the moment, is doing very well. Yes, there might be some consumer slowdown, but as I said before, it will not be affected as much by the AI apocalypse risk, I think, as the others. So I would keep that in a neutral ground, maybe, to watch and see what these two will do. Now, the losers, the big losers, I feel, in my opinion, and this is, again, I will state, this is my opinion, please do your own due diligence on this, is Salesforce and Workday. And the main reason, I think let's keep it simple. Salesforce is marketing and sales, Workday is HR and finance, and I think these are the two biggest market at risk of losing their seat. It's all about the seat on this. Obviously, can the seats run by humans be replaced by AI agents? In this instance, I think they can. There'll be fewer salespeople, fewer licenses. AI agents could compress the revenue down by quite a bit. And I think being from a recruitment background myself, so recruitment, sales, and HR, these jobs I feel are at risk within the next couple of years, even within the next couple of years, or even at least 5 years. I think the AI agents can take over all of that work through all of that, so sales, select the marketing strategies or HR issues. It can all be taken over by a sales agent, and that is where the key problems are for Salesforce and Workday. Now, I'm not saying they're going to go bust. I'm not saying they're going to go to the ground. Let's not over-exaggerate. I just feel that these two companies are more at risk than the others at this stage, and hence why I've put them into the high risk uncertainty department there, high risk of SaaS and issues there. So like I said, it says there, I'm just going to recap again. HR, one of the first areas AI can replace. Seat-based admin heavy workflow can be replaced, and it will cost nothing. So let's be honest. Where will these companies be? I am certainly Workday, I think, is even more at risk in that respect. Now, I don't like to pick anything specific, but again, this is from my research and doing a lot of research and looking into various different companies over the past 2 or 3 months, especially as, of course, we have also Intuit, which actually is not in that. Intuit is also another one that I feel potentially could be in danger, especially if they simplify some of the tax way of returning your tax by for the individual. But I still think this will be quite hard to replace. So I would probably put Intuit in the middle ground with Adobe. Shopify, I nearly forgot there. I won't be editing that one out. So that is a current rating at the moment. If I had to rate them, I think that S&P Global, Moody's, Intuit, and Adobe will be in the safety zone. Shopify I think will be pretty good, but I think these two at the bottom there are probably the most in danger with a -C and a D. Spotify. That's where we're at the moment. So I feel this is the situation at the moment in where we are at. What's the final wording on that really is the fact that AI is coming. AI is going to replace a lot of people, including probably myself as a recruiter, and it's quite scary for a lot of people. But for terms of companies and figures, I think some will clearly survive the test of time, and some will struggle and probably either disappear or being bought out. Now, I don't want to specify clearly a company. I've just given you what my model is at the moment. So I think artificial intelligence is going to change everything. That task once require a team, sales reps, designers, HR staff will disappear. AI agents will come into it. And obviously SaaS companies charge per seats. So obviously there will not be any more charges for that. So clearly that's where I think some companies will struggle. So that's my brief analysis really at the moment on that side of it. In terms of the SaaS, and please do make some comments below if you disagree with me or agree with me. Any comments will be great. I always like to get more. I don't get enough of them. Obviously, as a startup channel, I understand that most people kind of look through very quickly, but it'd be great to get some kind of feedback from you guys in terms of what your thoughts are and if I've missed out. Obviously, I couldn't go through all of them that I've stated, but I think pretty much at the moment as it stands, I think the companies that I've put through, I feel will survive. So let me know what you guys think. Moving on to the next subject here is the US and Iran agreement. Now, we have had obviously an 11th hour agreement very late on last night. And as it states there, the duration is 2 weeks ceasefire to create space for diplomatic talks. Now, obviously, the shipment and the hostile, we'll see what comes out of that, really, in terms of this. There'll be a mutual 14-day ceasefire. Iran will halt the regional militia attacks. The most important one on that list, the Strait of Hormuz will reopen, which has made a major difference to crude oil prices, which has dropped about 12%. We'll see that in a minute. Israel will pause major offensive, of course, on Iran, but not on Lebanon. So that's, I think, was stated this morning. And of course, US and Europe will ease select sanctions. So this is valid for 2 weeks. Checkpoint 14 days. Will it last? That is the question we've all got to go ask ourselves. I think this will be a tough one. So let's see what the headlines were from this morning.
When you want it with Bloomberg News Now. I'm Nathan Hager.
And I'm Karen Moscow.
Karen, relief is sweeping through markets and the world, with the U.S. and Iran pulling away from the brink 40 days into the Middle East war. President Trump announced a 2-week ceasefire last night, subject to Tehran reopening the Strait of Hormuz. The move came hours after the president warned, quote, a whole civilization will die tonight if Iran did not give in to his demands. Pakistan mediated to urge the president to back away from that threat.
So as you can see, this is the major headlines this morning that were popping everywhere on the market, obviously. So happy days. Now, what does it mean to the markets? Well, let's have a quick look now. And we can see we are in the green. A little bit off the highs of this morning, which was pretty much, I think the Nasdaq was up nearly 3%. It's now down still up 670 points. But the US 30, which is the S&P 500, obviously is up 2.62%. It's 1,200 points. That is quite a high this morning, and it's kept to that level. So that is amazing. Now, as you can see here, in the red is crude oil, which obviously was at 110, 112 yesterday. It has dropped nearly 12%. Currently at $95 a barrel, so quite a fallout obviously from this morning's ceasefire, which de-escalated the situation in the Middle East. So some of you may know I pulled out of S&P Global and Uber yesterday to be safe, and I turned out that I probably was a mistake. But it was about safety, and sometimes you guys need to think about your account, and especially if you're doing spread betting or in this instance, or even your own account, straight cash, you've got to be careful, especially with situations like that. Now, some people may say don't listen to the noise, but there was going to be a major pullback, I think, if there was going to be an obliteration of the Americans on Iran last night, which was looking like it could be. So I did not take the risk. But beauty of hindsight is an amazing thing. But I didn't. Unfortunately, in this instance, potentially, I should have probably stayed where I was. Although it's pulling back now to 73.50, so it was really just a more of a, I think, short-term buyers buying in very quickly. And we're now going back to some kind of reality a little bit. S&P Global is also coming off its highs of 440. I think Uber at some stage this morning was at a high of 75.5. Could have made money, could have made a substantial amount of money, but I went for safety. But at least I made a decision. Better make a decision than no decision at all as a trader. That's one of the things I've learned. So what does that leave in my portfolio? I have stayed with Visa, which actually is doing all right now. It's gone from, nearly 150 down to 44 and in the red. My short position on crude is still at 92, which I bought quite a while back. Hasn't quite reached that yet because obviously it's still ongoing in terms of negotiations, so I can see why potentially, and also just obviously releasing the pressure on the Strait of Hormuz, which will take a few weeks. So I'm thinking that hopefully oil will drop back down to 80, 70, so I will keep that position open for now. I've only got about 1,800 pounds worth of short there on that side. Short obviously meaning, for some of you that may not know, betting against the price of going up but going down. I'm betting on the price going down, so that would be interesting. As you can see, Adobe is still the same old story really, 244. One of my legacy mistakes that I've transferred from my other account into this new account, and still quite a bit down at the moment, hoping for a turnaround at some stage. So that's kind of where we are at the moment, really, guys. My watch list is still pretty much the same. I'm still looking at S&P, jumping back into S&P Global, but I pretty much know what price I'd like to buy at the moment. Same with Uber. I think Uber would be early 70s, something about 71. S&P Global, I would definitely jump back in if it drops below the buying initial price that I did which was 435. So anywhere around 425 would probably a buy for me at the moment. I just felt that the margin of safety was at only 23%, and my criteria is minimum 25. So I felt I could probably do better if there was to be another fallout on the markets. And there's always the next fallout at some stage. So I'm ready with my cash. I've got some more cash now available to spend. Whether I do it on one stock or two stocks, I'm not quite sure. I think because my account is quite small on this amount at the moment, I'd like to try to maybe more invest in one stock only. But anyway, all this is waiting to see what will happen. But certainly a better day on the markets today after that. And let's see what is the next step at the moment. It will be interesting to see where the market goes next on the back end. There's some economical news coming up, which I can go into maybe in the next few days. So there you go, guys. From one retail investor to another, this is Trader 72. I hope you guys enjoyed it. Please comment, please subscribe and like. Very important that you do. It would be much appreciated because obviously a lot of effort goes into this from my end. But I do enjoy it. I find it cathartic. So if nobody's listening to me, it is what it is. If some of you listen, great. And as I said, positive or negative comments, always good to learn to move forward. So please do comment on any of them and see if you agree with me. So there we go. So from a sunny afternoon in London, see you guys soon. Take care.